I'm now going to bring in Fotis. So good morning, and thank you very much for doing this
Morning,
again.
James. Nice to talk to you again.
So I'm going to let you drive. Tell us all about Impax environmental markets.
Absolutely. Let me just okay. So morning, everyone. Nice to be talking to you as well again today. So I'm gonna give you a bit of an introduction on Impax environmental markets, explain to you what the trust does, what we have been up to this year, and then open up for questions. So if we start with this slide, just a quick reminder of the investment thesis behind IEM. So in a world with finite resources and constant demand for higher living standards, we believe that companies enabling the cleaner and more efficient delivery of basic needs like water, food, energy, but also companies that are tackling and mitigating risks like climate change will grow earnings faster than the global economy. And in the long term, that should drive superior stock returns. So IM is really all about giving investors pure play exposure to this very attractive growth opportunity. And what I mean by pure play exposure is that for a company to be eligible for IEM, it needs to have at least half of its revenues coming from environmental markets. If we go to the next slide. So obviously the past couple of years, the world has been a very volatile place and performance has been a bit more challenging, but I think it's important to appreciate that and remember that IEM has been going on for about 25 years now, and the problems that it was designed to address, haven't really gone away because we have a Trump administration in the US or because AI has been monopolizing interest in markets for the past 2-3 years. So sadly, we still have global warming. We have more and more extreme weather events that are happening more frequently and they are more expensive to deal with. This is putting pressure on our water and energy networks. I mean, it's pretty scary to think that 25 years from now, half of the world's population will have to deal with some sort of water stress. So there is massive need for investment to address these issues, and this creates opportunities for the companies that provide the solutions to these problems. So, just summarizing the slide, I would say we are investing in not nice to have policy dependent products, but really in mission critical solutions that the world absolutely needs today. If we go to the next slide, in terms of key messages, I would say, first of all, that the drivers behind environmental markets, are as strong as ever, and that is supporting the thesis around superior earnings growth. Second is that for the past 3 years, we've been operating in a market that was all about mega cap tech, and small and mid cap companies have been pretty much as out of favor as they have ever been. So this is obviously a very fragile situation, and as market participation starts to broaden out, and we do see that already happening this year, I would say there are very strong diversification benefits in looking at a trust like IEM that has more than 99% active share versus global equities. Message number 3 is that with small and mid-cap companies being out of favor, the portfolio has suffered from a very aggressive derating versus global equities. So the relative valuation of the portfolio is at historically low levels. And on top of that, there is an additional 10% discount to NAV at the moment. And then my final key message is that we do have a very active and engaged board that really provides constructive challenge, is a very good sounding partner. So that also makes a difference. So these were some key messages for IAM. If we then go to the next slide, I think this is also an important slide because it really illustrates the core of the IAM investment thesis. So you can see on the right-hand side that over the long term, IEM has really delivered the superior earnings growth versus global equities that I have been talking about earlier. So this is really the thesis playing out. But of course, nothing is a straight line. So in the past 3 years, we have had a once in a lifetime disruption of supply chains after the COVID boom. And also we've had outsized earnings growth by mega cap AI companies that are not really in the opportunity set for IEM. So putting these two things together means that on a 3-year basis, our earnings growth has lagged global equities, and that has also affected our 5-year numbers. But, you know, the benefits of IM having been around for about 25 years is that we have seen before our markets falling out of favor. And what tends to happen is that our portfolio companies eventually re-establish themselves as high quality businesses with superior earnings growth. Also, something that's interesting to think about is that on 3 years, our earnings growth has been just below global equities, but at the same time, we have really suffered from a very violent relative derating. On slide 8, you can see the long-term performance figures for IEM, very numbers heavy slide. So let's go to the next one to see, what has been happening this year. This is the year-to-date performance to the end of May. So we're about 2% behind global equities and about 1.5% ahead of the ET100. The ET100 is a proxy, if you will, for environmental markets. So what we're seeing this year, I would say, it's not all about US and it's not all about mega cap tech anymore. Of course, there's still a lot of, uncertainty, volatility. Look, for example, what's happening in the US with tariffs. Every day is a different landscape. So that is, I would say that's not helping a SMID trust with a pro-cyclical bias like IEM, but we have actually held up pretty well in this volatility. So if we break the year in 2 quarters, Q1 we saw strong performance in Europe, but it was, if you look underneath that headline, performance has really come from energy and from aerospace and defense. So again, not really what's in the universe for IEM. So in Q1, we were 3.5% behind ACWI, but we have actually been gaining ground in the second quarter, where we have, signs of broadening market participation. We've had a pretty strong earnings season. So in the second quarter so far, IEM is about 1.5% ahead of global equities. What's interesting to talk about is, what have we been up to this year in this very volatile environment? So I would say after this period of weakness, and particularly after the fourth quarter of last year, that was, we had very weak performance at the time. We were in a situation where share prices had come off. There were a lot of opportunities out there. So we thought that this was a good time to try and use this weakness as an opportunity and come out on the other side with the best possible portfolio. So we looked mainly at 2 areas of the portfolio. The first one was some of our more vulnerable, fragile business models that we did not have a lot of conviction in. For example, some of our renewable energy equipment providers. And the second was companies where the thesis had played out, valuation was a bit more full, upside was not looking as attractive anymore. With so many opportunities out there, it did not make sense to keep holding on to names like that. So that process led to us exiting 14 positions this year, so very dynamic management of the portfolio, and establishing 9 new positions in areas that we're very excited about, we have a lot of conviction in. So I'm highlighting here on this slide in the middle 3 of those areas: electrification, digitalization, and climate change adaptation. So again, these are multi-decade issues, and we have a lot of companies in our opportunity set that provide solutions to these problems. And then in terms of investment styles, where have we been allocating to? I would say it's a bit of a mix of some more defensive business models and some more attractive growth opportunities. So all that activity ultimately resulted in a very high conviction portfolio that is more consolidated, has better quality metrics, and similar valuation and risk characteristics. If we go to the next slide, you can see the top 10 for IAM. So again, I would say it's a mix of some more resilient companies like Waste Connections and Clean Harbors, which are both waste management companies. Then we have some companies with more self-help potential, more idiosyncratic catalysts. I mean, the top holding here, DSM Firmenich, is a good example. It's a natural ingredients companies, and we had DSM merging with Firmenich a few years ago. So we're still, early on in some of the cost and revenue synergies being realized. So this is one of these situations where 1 and 1 equals more than 2, and there's a lot of value creation potential. And then the third category in the top 10, I would say some more attractive growth opportunities. Trimble is a good example. It's a software company that's digitizing the construction industry. So construction is the least digitized sector out there today. Massive inefficiencies, a lot of labor shortages, a lot of issues that make the prospects for the software solutions that Trimble provides pretty attractive. So that's what I would say on the top 10 mix of different sort of types, profiles of holdings. The next slide is looking a bit at our positioning versus global equities. So on the top left, you can see the market cap profile. So very much a SMID trust. 70% of the companies in the trust are below $20 billion market capitalization. The median company in the trust has a 9 billion market cap. So again, with small and mid caps having been so out of favor for the past 3 years, now we think this is a pretty interesting time to have that SMID bias as we look ahead. Then on the top right, you can see the key GEEKS sectors for the trust. Industrials, IT, materials, and utilities are the key ones. Bottom left, you can see the split between cyclicals and defensives. Just reiterating, we do have a pro-cyclical bias, but we're actually pretty balanced between defensives and cyclicals. And then finally, bottom right, you can see the regional breakdown. We do have an overweight in an underweight, in North America versus global equities. So again, with more signs of broadening market participation and all these sort of thesis in the market out there that we could be near the end of the US exceptionalism, this again might not be a bad place to be. And then I'm going to finish with this slide, which looks at earnings growth and valuation. I started by saying the thesis behind IAM is the delivery of superior earnings growth versus global equities. And here you can see on the left-hand side, the expectations. These are consensus expectations, so to be taken with a pinch of salt. But you can really see that the portfolio is expected to deliver faster earnings growth than ACWI. So that is in line with the thesis. And at the same time, if we look at valuation, relative valuation to global equities at the bottom right, you can see that it is really at historically low levels. The absolute valuation of the trust, which you can see at the top right, is in line with history, but it's important to appreciate that there's been a very big mix shift within the trust for the past 5-7 years. So today we own a lot of software, technology companies, higher multiple sectors that offer more resilient characteristics. So absolute valuation in line with history, but relative valuation, pretty much as low as it has ever been. So I will pause here and I will open up for questions. Back to you, James.
Brilliant. Thank you very much, Fotis. That's really good. We've got a good cover of the trust there, I think. One question that popped up early on here that I think is probably worth exploring. So has the definition of what constitutes an environmental stock changed since you launched it?
Yeah, I would say no, not at all. Going back to what I said at the beginning, this is all about identifying the solution providers to the more efficient delivery of basic needs and to mitigating climate change. All these sort of what has happened in the past sort of 3-4 years is that, we've had this, as you said, the woke agenda. We've had the politicization of the term ESG, which is a very misunderstood and misused term. IM is all about investing in markets with superior earnings growth. It's all about risk-adjusted returns. It's all about performance. For us, ESG is part of our fundamental analysis on a company. It's a sign of corporate resilience. It helps with risk management. But the term ESG investor, I don't even know what an ESG investor is. It means 100 different things to 100 different people. So yeah, again, IM is all about investing in companies providing solutions to multi-decade problems that the world faces today, like water scarcity, food scarcity, need for more electricity.
Thank you. Now, there's lots of questions about Trump, not surprisingly, probably. So to try and break this down a bit, how sensitive is the portfolio to what's going on in the economy generally? So if he triggered a recession in the US, would that be a problem? Or are these sorts of things that grow regardless?
Yeah, so I would say if we had a US recession, that would be bad for equities. There's no question around that. But there's a few nuances here. So first of all, what would be more vulnerable would be the part of global equities that has been, doing better in the past 2-3 years. And again, goes back to my point that we have had a super concentrated market, and that is a very fragile situation to be in. So trust like IEM, where we have our Schmidt bias, we've had some challenges, I was saying before, coming from a disruption of supply chains. There is valuation is already at pretty low levels relative to history. So that's point number one. Point number two is we have been trying to position the portfolio to some more resilient business models. I mentioned that when I was talking about activity year to date, have added companies that should behave more defensively through the economic cycle. And then my third point excuse me, would be that if you look at some of the more cyclical exposures in the portfolio, like construction, for example, we have really taken profit in some of these names. If you go to the beginning of the year, construction was high teens, just below 20% of the portfolio. Now we're much closer to low double digits. Automotive, another very cyclical sector, is less than 3% total exposure for the portfolio. So we have been trying to take action across different sort of fronts. Yeah, that's what I would say.
Thank you. So then the next part of the question is, obviously under Biden we had Inflation Reduction Act, but which is obviously really all about driving things like climate change and spending and that sort of thing. And they seem hell-bent on reversing a lot of that. Does that have an impact?
Yes, so that's another thing we have spent quite a bit of time trying to understand. Where is the policy sensitivity in the trust? And I would say it's really concentrated in two areas, renewables and automotive exposure, electric vehicles, basically. And you see that in the news that comes out of the US, what has been getting the most headlines are subsidies for renewables might get ramped down much faster than people thought. Tax credits for electric vehicles. We've all been following the online conversation between Trump and Musk yesterday. So this is really, what's at the eye of the storm. And these are two areas that we have very limited exposure in IEM. That's actually a common misconception. People think of environmental markets and IEM as a renewable energy trust. That could not be further from the truth. So renewables today are about 6-7%. Automotive is another 2-3%. So let's call it about 10% that is more sensitive to these policies that Trump seems to be pushing forward. At the same time, if you think what is Trump all about, it's about more infrastructure in the US. It's about industrial footprint getting re-established in the US. Our companies, companies that we have a lot more exposure to in energy efficiency, in water infrastructure, grid infrastructure, waste management, are all companies that would benefit from this pickup of industrial activity in the United States. So I would say it's actually a lot more positive than the negative headlines suggest.
Thank you. And then one more on this. I know we're sort of stuck in a rut here, but on
Yep.
tariffs, do tariffs make a difference to some of your companies?
Tariffs definitely create a lot of noise. Again, as we said before, the tariffs regime is changing every week pretty much. So we are trying not to make any, knee-jerk reactions. But what we have done is, again, systematically go through the trust and think about where is the impact in the portfolio. So I would say we do have some companies that are negatively impacted by tariffs. These are some of the more, cyclically exposed companies. Automotive is a good example. So yeah, we do have some companies in that category. That's, let's call it about 10% of the trust. But then we have, quite a few companies that are, a lot more resilient, a lot more defensive business models. For example, some of our water utilities, some of the waste utilities, these should be a lot more insulated. And that's about 40% of the trust. Then we have a similar level of exposure in companies where tariffs will create noise, undoubtedly, but at the end of the day, these companies will be able to deal with that. And it's not that long ago that we've had completely disrupted supply chains after COVID, and companies again had to adapt, had to be very flexible, and they did a very good job. And I think that experience is going to be again very useful for what happens now with tariffs. So I would say tariffs create noise, but ultimately I feel companies in IM are well positioned to deal with that.
Okay, thank you. Then looking at sort of changing the geography a second. So
Yep.
China. So have you got exposure to China in the portfolio? And obviously they seem to be spending a lot of money trying to decarbonize their economy and things like, solar panels and stuff they dominate. Are there industries in China that are interesting from that point of view?
Yes. So I would say the single most attractive industry where China is really ahead on a global basis is energy storage with contemporary amperex technologies with cattle. So this is really the global leader in batteries, in energy storage, across chemistries, across applications, whether we're talking about electric vehicles or stationary storage. So this is really a standout. So, and that is a company we do hold in IEM. So that's definitely a very sort of higher conviction holding. I would say other areas in China, there is definitely some interesting automation companies, and we did have an investment that we have now exited that was active as exactly in industrial automation, had a bit of exposure to the emerging supply chain of industrial robots, humanoid robots. So definitely some interesting cases there as well. But really, energy storage and cattle stand out, I would say, in terms of our Asia.
Thank you. Now, thinking about this slide, what's been going on here, and a bit about this derating that's happened, some of that must be linked to interest rates going up. And I know we've seen very long-term interest rates don't go back up again, but at the same time, we've got interest rate cuts at the short end. And should that be feeding through into valuations, do you think? If nothing else was going on, it would just be this sort of static period. Would you be expecting to have a re-rating now?
Yeah, I would say we definitely had an impact from interest rates staying higher. That impact was more evident in our renewable energy companies, our project developers mainly, where a lot of them now trade at valuations below the value of their operating assets, which doesn't make a lot of sense. So where we are now, you did mention, in the long end of the curve, interest rates are going up. There's a bit of uncertainty around debt at the moment, sovereign debt. But, in the short term, sort of where we are today, I would say, interest rates are probably the move is expected to be eventually ramping down. So that should definitely be helpful for some parts of the portfolio. I wouldn't say that the case of IAM is that it's going to re-rate. It's about delivering earnings growth, but we do have some more interest rate sensitive sectors that would benefit from rates eventually coming down.
Let's go back to the top 10 holdings for a second. I've got a specific question. Can you tell us a bit more about Darbar India,
Yes.
please?
So this is an India company, as the name suggests, and it's active in ingredients that end up in products like beverages, nutritional supplements. And it's all about natural ingredients. They have a big sort of Ayurvedic background, all about natural ingredients. So it has this, pretty interesting exposure to India, of course, to the Indian consumer, where there is definitely, we've seen higher spending power over time. There's, of course, this massive volume potential. So that's sort of an attractive characteristic, an attractive end market exposure. It is a dominant company in the country, so it's really one of the few that have such strong brand power, quite a broad offering of products. So that makes a difference when you approach the sort of endpoint sellers, that you can offer them a lot of different products. You occupy more shelf space. So yeah, there's some interesting dynamics. There's been some challenges recently in India with weather being extreme, and that's impacting consumption of certain end markets, certain geographies. We've had an emergence of e-commerce, so again, that's changing the landscape a little bit in these range of products. But ultimately, Dabur is one of the leaders in this space in India.
The other stock that's specifically mentioned here in the questions is Croda. Is that something you still hold, and what's the outlook for that?
Yes. So Croda is again similar trend in sticking with natural ingredient within a category. It has had some very difficult years for the past sort of 2-3 years. That's again coming out of the COVID boom, a lot of destocking. Croda did not have great visibility on how much inventories were sitting in the channel, so it got caught in this situation. I think the company has been talking about, has been making changes on that side of things, getting a better grip of inventories, trying to sort of, it's had this issue with under absorption of fixed costs. So we have started seeing in the last quarterly results, things getting better. But yeah, it has been quite a difficult time for Croda. But, that's also potentially the opportunity, because ultimately we still believe this is a good franchise. It's had some issues, but yeah, as the latest results suggests, things might be getting better.
Thank you. Now, I know there's a slide in here later on, which shows you what's been driving the returns.
It's slide 20.
There we go. Cool, year to date. Can you just sort of talk us through a couple of these, please? Which is just kind of interesting to see what's going on.
So, I would say general comment on the positive contributors is that we have a lot of more resilient business models. Starting from the top, Sabesp, water utility in Sao Paulo in Brazil. What's interesting, by the way, is that Sao Paulo has had a long history of dealing with droughts, going back to my point around water scarcity at the beginning. So it's very important, to have a company like that that knows how to deal with, sort of boost the water network there. But why has it been strong this year is that Sabesp is getting privatized. So there is a big opportunity to improve margins, get the organization running more efficiently. So that's why the share price has been strong. Then second company is Coway, making point of use water purification products. It's a Korean company. So why has it been strong? I would say very strong position in its core market in Korea. So gaining even more share in that market. That's because they have a product that's better than the competition. They're also, been getting better in selling this product internationally, key end markets like Thailand and Malaysia, so seeing strength there. And then third point is that they're getting more shareholder friendly, returning more cash in buybacks, dividends. So all these three things together, have explained the strong share price performance. And then Shenzhen Innovance is the holding I was talking about before, China company that we have now exited. But it did benefit from all this excitement around humanoid robots. So valuation got to a point where it was no longer very attractive. So we moved on from that one. But yeah, if you go a bit further down, American Water Works, again, a utility in the US. At the very bottom, Veolia Environment, that's a water and waste utility we've added earlier this year. So nice to see that doing well. So generally, the theme here is that some of our more resilient business models are delivering good performance. Now, in terms of what's not working, I would say, we have some. If you see these names, it's mainly reflecting concerns around economic outlook. And also some of our digital infrastructure names that have been delivering very strong performance for the past 2-3 years are giving some of that back. A good example is PTC at the very top of that list, software company used by industrial engineers to design products, monitor their manufacturing, and then service them better in the field with digital twins. So it's interesting, if you look at the performance of PTC for the past 3 years, looks very strong. But if you read the commentary, they're saying that we've been operating in an industrial recession environment for almost 2-3 years now. So very resilient business model, still very tough end market, and add on top of that the noise around US recession, tariffs, etc., that explains some of the weakness. Generac and Littelfuse, again, a bit of tariff noise. Generac has sources some of its components from China, so that created a bit of short-term uncertainty. And then, Generac makes backup power generators, which one could say is a discretionary product. So in a recessionary environment, people might not be buying it as much. But, we're talking about the US, where we have wildfires, power outages every few months. So, they're only discretionary until the next power outage when thousands of people are without power in their homes. And then Littelfuse does have some automotive exposure. Again, automotive market is probably the eye of the storm around sensitivity to economic cycle, tariffs. So that explains some of the weakness there.
That's great. Thank you
Of
very
course.
much. One more question that we could just get answered, I think, while we there's just enough time. Would you hold anything that could be considered like a dirty company because it contributes to the environmental story? And I'm guessing that probably the implication underneath that is something like a mining company producing essential minerals, that's that sort of thing.
Yes. So going back to what I was explaining the thesis behind IAM in the beginning, we are investing in pure play solution providers. So any company that has more than 50% of its revenues contributing to positive solutions in environmental markets is eligible for the universe. Then, our bottom up, that makes it eligible, doesn't mean that we would automatically own it. Then comes the fundamental analysis, looking at corporate resilience. We haven't owned a mining company so far, but that's not to say we would never do that. Again, it comes back down to getting confidence around, is this a good operator? Is it managing its risks appropriately? And properly understanding also what's the outlook for the whatever commodity it is that they are mining. So it depends, but they're eligible for the universe, I would say.
Brilliant. Thank you very much indeed. We've covered a lot of stuff here, and I think we've answered most of the questions. So we'll probably wrap it up there. But thank you very much for your time this
Great.
morning.
Very nice to talk to you and to all the
Um,
audience.
and to make sure you get a chance to freeze on the mornings because that's very important. Thank you, Andrew. Thank you, Fotis. We'll be back next week, and we've got the managers of Global Opportunities Trust in. I do think this is an interesting fund. It's doing something very different, and they've got an interesting story to tell. So have a good weekend, one and all, and I will see you next Friday.